What are some of the basics that people should know if they even want to understand the mindset of investing, or even basic mistakes that people make? What can you tell people that maybe this is the first time they're thinking about this concept?
Well, probably, I mean, when you get down to the really basics, it's the idea of making more than you spend, and then finding a way to compound that in a relatively safe but still risk-taking way to exponentially grow that capital over time. And one story I like to tell is that, for example, my father had, he was a police officer for a long time, and then he had a second career. So he was hardworking his entire life. He was working since he was a teenager. Um, he had literally a perfect credit score. He paid every bill on time, and he just never built his wealth, right? So he lived in an apartment. He lived in a trailer park. He wasn't bad with money, but he just kind of was always just enough, right? And there's no like idea to like put things aside and compound it over time. And so it's like if you miss one small thing, it can change everything else. And so my whole approach was to add that extra step of be good with money, but also find a way to compound it. And I think another big thing that people miss is they're always focused heavily on ways to save money, which is useful. But it's also, I mean, I think a more powerful thing is find ways to make additional money, um, either by obviously finding ways to increase your career standing, right? So find ways to move up in your business, or by having a side hustle. And obviously that's becoming more popular today than when I started doing that, over a decade ago. We've kind of shifted more and more towards a gig economy. But it's still something that, if people did more of, I think they'd have an easier time once they really get going after maybe 5 years of that. It's like work up front, but then it's a lot more smooth sailing when they're more financially secure. And it is a shame that they don't teach it more in schools. It's kind of remarkable. I never learned it in school. You have like one in math class, they'll have a couple, word problems about compounding or banking and things like that. But other than that, you never actually learn personal finance. Like we learned all sorts of things. We learn like different types of jellyfish and things like that, but we don't learn how to manage money. And it's one of like the top five skills someone has to know in life, right? So managing resources is something that humans have been doing since the beginning. And money is just obviously our modern version of managing resources. I had ambitions when I was young to do that. And it is the whole point was never that I wanted to retire early, is that I wanted to have the option to retire early, basically to be financially free early so that I can then either, continue working on what I was working, work on something else, work on whatever I want. And so in that sense, it basically went according to plan. And it's one of those things where, in my say mid to late 20s, I was a little bit kind of undershooting that goal from what I wanted. Whereas by the time I got to my early 30s, I had overshot that goal. So it's one of those things. I think it's even like a Bill Gates quote where it's like people overestimate what they can do in like a week, but they underestimate what they can do in 10 years, right? So it's the way that the mind works. So it's like we don't give ourselves enough credit for how big we can do something in 5 or 10 years, whereas we always overestimate what we can do in a short period of time. And so basically by catching up and ramping up, I kind of actually exceeded my goal. I thought maybe by my late 30s or I'd be more independent, whereas I kind of got it into that early to mid 30s. I find that a picture is worth 1,000 words, and so a chart just showing what something cost over a century, for example, tells you almost everything you need to know about inflation. And sometimes I try to think back to like when I started saving and investing, I was like a little kid. I was like, we basically, I was impoverished when I was a child, and then I moved in with my father, and we were, more comfortable. And I started saving and investing when I was not even 10 yet. And I shifted into, in addition to just, saving cash from like, birthday presents and stuff, I shifted into like little tiny silver coins, and eventually like little like fractional ounce gold coins. And somewhere along the way, I knew what inflation was. I think it's because I was always mathematically inclined. And so I just kind of, it's just something that just kind of randomly clicked with me. But I think for a lot of people, it's showing them a chart of inflation over time. And going back to my father's example of how he saved, but he never compounded, right? He always was financially secure, but never, I guess, abundant, is because he would save for things, but he didn't understand investing at all. And back then, you could at least earn a yield that exceeded inflation. but it was still maybe smaller than people think. So people think that they're earning 5 or 6% from the bank, but inflation's 3%. They're earning like half of what they think they are in terms of actual purchasing power. And then you're also, if that inflation metric is understated, actually inflation's still higher, then maybe they're not even saving that much or earning that much. And so I think it's one of those things where people really need to go look at these long-term charts and also just run the math, especially in the modern times where interest rates are below the inflation rate in most countries, especially most developed countries. Saving is a very challenging thing for people because you're constantly, adding more ice to like a hot area that's just melting constantly. So it's like this, you're on a treadmill rather than a long-term compounding approach with that. Well, I mean, overall, the issue is we're seeing basically a giant disconnect between inflation and rates. And so, the United States right now it's 6.2% official CPI, probably higher if you measure it in the way it used to be measured, while rates are near zero in just about every developed country. And the same problem is throughout Europe at the current time. The same problem is in most places. And so that, one of the key takeaways is that basically the world's now entering an inflationary spike that we've not seen for a period of time. And of course, there's different debates about how persistent it is going to be and how sticky it is, how kind of what's causing it. But overall, it's something that for a while, for the past couple of decades, you could kind of get away with not following inflation. Um, whereas now, because there's such a disconnect between rates and inflation, is something that every person has to know. Because if you're simply failing to grow your wealth, that's one thing. But if you're actively losing purchasing power with your money in the bank at a notable rate, that's a more serious problem that people have to pay attention to. I think, I mean, there's a big disconnect between my readership and people on the street, right? So my readership is self-selecting towards people that are already interested in the subject and generally know about the subject. And so they get it. It's something I cover quite a bit. Whereas, a lot of people I run into, they just, they don't fully grasp what it means to, have that deep of a negative yield, right? So they kind of assume that the curve it's I would describe it as recency bias. So as people, as humans, we often think that the last 5 years are going to tell us a lot about the next 5 years, or the last 10 years about the next 10 years, right? Things we assume some degree of stability. And so even though this past decade was a pretty bad one for savers, it was hard to notice because it wasn't too severe. And they assume that maybe the next decade's like that. They'll think I probably should invest, um, but I don't know how to. It's scary. They're worried about volatility, and especially with it is challenging because with stock valuations so high, especially in the U.S. and many places have very high home valuations, it is intimidating for investors to come in. And so they feel like they're stuck between a rock and a hard place. They're like, well, there's expensive assets. I don't understand. They're volatile. What if the market crashes? And then they're like, or I can just hold this melting ice cube. And many of them aren't fully aware of just how rapidly that ice cube melts.